What is going on, guys? Nick here, back with another video. Netflix announced its third quarter earnings on October 20th of 2020, and the results were a little disappointing. They fell short of Wall Street estimate subscriber growth by about 1 million subscriptions, although it was only 300,000 less than Netflix's own forecast, and the share price is still down about 8% since the earnings release. With most people stuck at home with nothing else to do other than Netflix and chill, I thought it would be a good time to take a look at the stock and see if this was just a bad quarter or is this a new trend starting to emerge. Netflix obviously makes its money by selling monthly subscription memberships. The more subscribers, the more it's able to make. Netflix realized early on that there's only so much growth that they're able to obtain in the US, and for them to continue to grow, they would need to expand to an international audience. So here's Netflix's total subscriber count since 2011. You can obviously see that they've been growing at an incredible rate. If we look at the percentage gain per year, we can see that this is slowing from the incredible 40% growth we saw early in the decade, as you would expect, but it seems like it's settling in at just over 20% growth. Now, what's interesting is we see a boost between the 2019 and 2020 growth rate. Management explained that this boost is likely due to the huge increase of everyone being stuck at home. I also think that the Tiger King going so viral in March helped out with this a little. Now, Netflix did recently switch how it reports its segments. They used to break themselves into domestic, which was the US market only, and the international markets. We can see the rapid growth that they started to develop in their international markets while the US market is slowing down. If we look at this by percentage growth, we can see that at least up until 2018, international growth was growing around 40% while domestic growth was around 10%. Then in 2019, Netflix decided to switch themselves into 4 segments: the US and Canada market, the European, Middle East and African market, Latin American market, and the Asian Pacific market. We can see that they're succeeding the most in the European, Middle East, and African market, and this seems to make sense because the European market, at least, is culturally most similar to the US, so most of their content will already be popular. We've also seen shows that were launched out of the UK do pretty well in the US. Now, Netflix says that it sees a lot of potential in the Asian Pacific market, and with 60% of the world's population, this could represent a massive opportunity. However, they've had some issues breaking into the Chinese market. They actually aren't in China at all right now. In 2017, Netflix partnered with a Chinese streaming service called iQIYI. Netflix agreed to license some of its original content to iQIYI to gain access to the Chinese market, but that agreement ended after the content failed to catch on. One analyst said that Netflix actually made no headway in China whatsoever, and that inevitably Netflix needs to partner, place greater focus on commissioning locally produced content, and address censorship with its own originals. The current strategy seems to be creating shows for Mandarin speakers outside of China. Netflix has actually had success in the Indian market. In 2018, they had only about 2% of the Indian market share, while Hotstar had a massive 40%. Since then, Netflix has made big gains in India. Right now, Netflix and Amazon Prime Video are actually the market share leaders with 20% each. In third, with 17% of the market share, is Hotstar, which was purchased by Disney in February of 2020. A Netflix subscription in India only costs about $4.70, which is well below Netflix's average global cost, around $9 to $10 per month. Right now, only about half of the population in India has internet access, so this is still a developing area. They're making improvements quickly though, because just 5 years ago, only 25% had internet access. In 2019, it was announced that Netflix would spend another $400 million over the next 2 years for locally produced content. One of the big barriers to market entry is you need to draw in new subscribers with content they'll enjoy. Making content that connects with different areas is essential for gaining subscribers, so this is a good sign. Now, one thing I've heard others say about Netflix is that they have tools to generate more income if they need to by just raising prices. I actually don't agree with this opinion. In most areas, there are already plenty of other streaming options. In the US, for example, there's Disney Plus, which only costs about $7 a month, and Amazon Prime Video, which comes with an Amazon Prime subscription, is only about $12 a month. You can only raise prices so much before users will cancel because you're charging so much more than your competition. I also don't really think that raising prices, unless it is absolutely necessary, is something that Netflix is really interested in doing. Netflix's CEO Reed Hastings explained some of his philosophy in a question about users signing up for 1 month, binging a bunch of shows, and then canceling. Reed said that he wasn't really interested in locking customers in to prevent this. It seems to show that they're interested in providing value to keep their customers rather than creating rules to get the most out of every member. And in my opinion, this is also a better strategy long term anyways. Now, one other concern I see is because Netflix faces very strong competition for content going against Disney+, Hulu, HBO, and even YouTube, that they've had to finance their content creation with debt. Now, debt can be a double-edged sword where you can use it for incredible growth, but if that investment doesn't pay off, it can be very painful and hurt you in other areas. Right now, their total debt is about $15 billion, and while this is twice their current equity, I don't see this as a problem at this point because they currently have $10 billion in current assets. Current assets are basically on-hand cash and other short-term investments, plus money they're owed within the next year. So let's take a look at the valuation and see if right now is a good time to buy. But before I do that, if this video has been helpful, please take a second to scroll down and hit the thumbs up button. I put a lot of effort into making sure these videos give you thoughtful analysis, and if you could pay me back with a quick thumbs up, I would really appreciate it. So the most important part of this valuation is really the growth rate you see Netflix able to achieve going forward. When you hear me talk about expected growth rates for a company, I'm trying to estimate what I can reasonably expect going forward over the next 10 years. What is a little concerning with Netflix is if we look at the year-over-year revenue growth, we can see growth has slowed pretty significantly in the past couple years. When we include the forecasted earnings for the rest of 2020 and 2021, we can see the revenue growth rate is expected to continue to decline. For this valuation, I'm going to use a growth rate of 15%. I expect Netflix to stay well ahead of this growth rate for at least a couple of years because of its largest segment, the US and Canada, is still growing at 8%, and the second largest, the European, Middle Eastern, and African market, is still over 20%. I also think later on down the road that they still have a potential for a boost with the Asian market coming in. So a 15% growth rate comes out to a fair PE value of 38. When we look at the trailing earnings per share for Netflix, they made about $6.19 per share. That's about 50% below the current share price. When we take a look at the earnings for next year, 2021, the forecasted earnings per share is $9.02. This means the forward valuation for Netflix is $343. This is still about 30% below the current share price. If we reverse the formula I used to calculate the fair PE ratio, this would mean that Netflix needs to grow at about 23% going forward based off of the trailing earnings, or 19% based off of the 2021 forecasted earnings. To me, this seems slightly higher than what I'd be willing to pay. This doesn't necessarily mean that Netflix's stock price is going to crash and burn and you need to sell immediately. It's very possible that the share price continues to grow. I just think that right now the price is a little expensive, but Netflix is clearly a very great business. I'm definitely keeping my eye on Netflix though, and I'll be watching for any drop in the share price for an opportunity to buy. Looking at the technical data, it does seem that we have very strong support around $470, and if that support is broken and it falls below 470, it could be a very significant drop. So I would keep an eye on this if you do currently own shares. Now, as a quick disclaimer, I don't own any Netflix stock and I don't really plan to buy any right now. If the conditions I just discussed happened, I probably would change my mind on this. Again, I do think Netflix is a great business. Now, if you found this video helpful, feel free to subscribe and make sure you hit the bell notification so you know when I upload a new video. And as always, thanks for watching.